Imagine if I told you that you don't need to pick individual stocks, track the market every day, or spend hours researching to start building wealth in the US stock market. Because there are just 4 index funds every beginner investor should know about, and they can help you grow your money steadily and safely over time. If you're ready to take control of your financial future, hit that like button now, and don't forget to subscribe to AI Cash Cortex. We break down complex finance with AI-powered insights every week, making investing simple and accessible. But before we dive into the funds themselves, let's start with the basics. What exactly is an index fund, and why do they make such a great choice for beginners? At its core, an index fund is a type of investment that tries to match the performance of a specific market index, like the S&P 500. Instead of buying shares in individual companies, you buy a tiny piece of hundreds, sometimes thousands, of companies all at once. This diversification lowers your risk compared to buying single stocks. If one company tanks, it's balanced out by others. Index funds have been around for decades, but really took off in popularity because they're low cost and perform better than many actively managed funds over time. Here's a story of Emily, a beginner investor who was overwhelmed by stock picking. She found peace of mind and steady growth by investing in index funds. Why are index funds a beginner's best friend? First, they offer diversification. Spreading your investment across many companies reduces risk. Second, they come with low fees because they track an index automatically. No expensive fund managers are needed. Third, they're simple and transparent. You always know what you own because it mirrors a well-known index. Fourth, they encourage long-term investing. Buy, hold, and let the market grow your money. Emily started with just $500 in an index fund. Over 5 years, her investment steadily grew, riding the waves of the market without the stress of stock picking. Many beginners worry that index funds mean missing out on big gains. They wonder, if I'm just following a market, how can I beat it? The truth is, very few actively managed funds beat the market consistently over the long term, and the fees those funds charge can eat into your returns. Index funds give you market average returns, and over decades, that average has been quite powerful. Another misconception: index funds are boring or too safe. But for most investors, steady growth with less risk is exactly what they need. Fees are one of the biggest enemies of investment growth. Imagine you pay 1% in fees every year. It might not sound like much, but over 30 years, that small fee can cost you hundreds of thousands of dollars. Index funds typically have fees under 0.1%, meaning more of your money stays invested and working for you. Emily's choice to invest in low-fee index funds meant she kept more of her earnings, letting compounding work its magic. Starting with index funds is easier than you think. You don't need a lot of money up front. Many brokers allow you to start with as little as $100 or even less. You open a brokerage account, pick the index funds you want, and make regular contributions. It's that simple. The key is consistency. Invest regularly, stay patient, and avoid trying to time the market. To sum it up, index funds offer a low-cost, diversified, and simple way to invest in the stock market. They're ideal for beginners because they reduce risk, lower fees, and encourage long-term growth. With stories like Emily's, it's clear that investing doesn't have to be complicated to be successful. Let's start with one of the most popular and beginner-friendly index funds out there, the Vanguard Total Stock Market Index Fund, ticker symbol VTSAX. This fund gives you exposure to nearly the entire U.S. stock market, from giant companies like Apple and Microsoft to smaller firms you might not have heard of. Imagine owning a tiny piece of every publicly traded company in the United States, all in one investment. That's the power of VTSAX. VTSAX covers more than 3,500 U.S. companies of all sizes, large cap, mid cap, and small cap stocks. This broad exposure means you're not putting all your eggs in one basket. Large companies provide stability, while smaller companies offer growth potential. This mix helps balance risk and reward over time. First, the expense ratio is extremely low, about 0.04%. That means only 4 cents per $100 invested goes toward fees, so most of your money stays invested. Second, it's very easy to buy and hold. You can invest through Vanguard or many online brokers with a low minimum investment, sometimes as little as $1,000. Third, because it tracks the entire market, it's less volatile than picking individual stocks, making it a safer choice for beginners. Take Sarah, a 28-year-old teacher from Ohio. She started investing in VTSAX with $1,000 and added $200 each month. Over 5 years, her investment grew steadily, weathering market ups and downs. Because of VTSAX's broad exposure, Sarah never had to worry about missing out on big winners or getting crushed by small losses. She stayed consistent and trusted the market. To invest in VTSAX, you can open an account directly with Vanguard or through a brokerage that offers Vanguard funds. You'll typically need a minimum of $1,000 to get started. Many brokers now offer fractional shares if you want to start smaller. Setting up automatic monthly contributions helps build your investment steadily without stressing over timing. VTSAX offers beginner investors a simple, low-cost way to own the entire U.S. stock market with built-in diversification. It's perfect if you want to grow your money steadily and minimize the risk of picking individual stocks. And remember, staying invested for the long term is the key to success. Next up is the Vanguard 500 Index Fund, ticker symbol VFIAX. This fund tracks the S&P 500, which includes the 500 largest publicly traded companies in the U.S. Think of it as owning a piece of America's biggest and most influential companies, from tech giants like Apple and Google to industrial leaders like Boeing. VFIAX focuses on large-cap stocks, representing about 80% of the U.S. stock market's total value. Because these companies are well-established, the fund tends to be more stable than funds that include smaller companies. It's often called a cornerstone for many investment portfolios. The S&P 500 has a long history of delivering solid returns over time. Investors like VFIAX for its consistent growth, low fees, around 0.04%, and simplicity. It's a great way to invest in the overall health of the U.S. economy. Meet David, a 32-year-old software engineer from California. He started investing in VFIAX as part of his retirement plan, contributing steadily each paycheck. David found peace in knowing his money was tied to some of the strongest companies, with less risk than picking individual stocks. Just like VTSAX, you can invest in VFIAX directly through Vanguard or many brokerages. Minimum investment is typically $3,000, but fractional shares and ETFs that track the same index are available for smaller investments. Setting a consistent investment schedule helps harness the power of dollar-cost averaging. While both funds cover the U.S. stock market, VTSAX includes small and mid-cap companies as well, offering broader exposure. VFIAX focuses on the large-cap giants, which tend to be more stable but may have less growth potential. Many investors include both funds to balance growth and stability. VFIAX is an excellent choice if you want to invest in America's largest companies with a history of growth. It's a solid, stable foundation for any beginner's portfolio. And as always, patience and consistency are your best allies. Now, let's talk about expanding your horizons beyond the U.S. The Vanguard Total International Stock Index Fund, ticker VTIAX. This fund invests in thousands of companies outside the United States, from developed markets like Europe and Japan to emerging markets like China and Brazil. International diversification is a key piece of building a balanced investment portfolio. Why invest internationally? Because the U.S. market doesn't move in isolation. Sometimes when the U.S. market dips, other countries' markets rise, and vice versa. Having international exposure helps reduce risk and smooth out returns over time. For example, when emerging markets are growing fast, investors in VTIAX can benefit, even if the U.S. market is slowing. VTIAX covers more than 7,000 companies outside the U.S., including big multinationals and smaller firms across different industries. It also exposes investors to different currencies, which can add another layer of diversification, but also some extra risk. For beginners, adding international stocks means balancing potential rewards with currency fluctuations. Consider Maria, a 35-year-old nurse from Texas. She started adding VTIAX to her portfolio to reduce reliance on the U.S. market. Though international stocks sometimes feel less familiar, Maria liked knowing her money was growing globally, especially in fast-growing economies she wouldn't otherwise access. Many financial advisors recommend allocating about 20% to 30% of your stock portfolio to international funds like VTIAX. You can invest through Vanguard or other brokers, often with low minimums or fractional shares. Remember, international investing is about patience and diversification, not quick wins. VTIAX provides essential global exposure, helping spread risk and tap into growth outside the U.S. For beginners, it's a smart way to diversify and build a more resilient portfolio over time. Finally, let's talk about the safety net of your investment portfolio, the Vanguard Total Bond Market Index Fund, ticker VBTLX. While stocks offer growth, bonds provide stability and income, helping to balance risk, especially during market downturns. VBTLX invests in thousands of U.S. investment-grade bonds, including government, corporate, and mortgage-backed securities. These bonds pay regular interest, which provides income and helps cushion your portfolio when stocks dip. Bonds tend to be less volatile than stocks, so including them can reduce overall portfolio risk. For example, during stock market downturns, bonds often hold steady or even increase in value. This makes them ideal for conservative investors or those nearing retirement. Meet James, a 45-year-old teacher who started adding VBTLX to his portfolio to protect his savings as retirement approached. The bond income gave him peace of mind during volatile market times, helping him stay invested without panic. Many investors adjust their bond allocation based on age or risk tolerance. More bonds as you get closer to retirement for safety, fewer if you're younger and seeking growth. Typical allocations might range from 20% to 50% bonds. You can invest in VBTLX through Vanguard or brokers that offer Vanguard funds, often with low minimums or fractional shares. VBTLX provides steady income and reduces portfolio risk, making it a crucial component for balanced investing, especially for beginners who want to protect their savings. Including bonds helps you weather market storms and stay on track for your financial goals. To wrap things up, these 4 Vanguard index funds, VTSAX, VFIAX, VTIAX, and VBTLX, offer a simple, low-cost, and diversified foundation for beginner investors in the U.S. Each plays a vital role: broad market exposure, large cap stability, international growth, and bond-based safety. The key is consistency, patience, and a long-term mindset. You don't need to pick the hottest stocks or time the market to build wealth. Ready to start your investing journey? Begin with one or more of these funds, invest regularly, and watch your money grow over time. If you found this video helpful, please like, subscribe, and comment below which fund you're most excited to learn more about or invest in. Thanks for watching AI Cash Cortex, your AI-powered guide to smarter money decisions.